Investing turns from math into a complete wealth system. Let's break down how compound interest, rule of 72, plus dollar cost averaging, DCA, all work together like teammates on the same mission, turning small, consistent money into real long term wealth. Think of them as a team: role, concept, what it does. The engineer, compound interest, builds your wealth automatically through reinvested returns. The timekeeper, rule of 72, measures how fast your wealth doubles. The protector, dollar cost averaging, keeps you investing safely during market ups and downs. Together, they create a machine that never stops growing, even when markets move against you. Step by step, how they work together. You start small but steady. DCA begins the process line. You decide to invest a fixed amount every month, say 1,000 EGP. You don't try to predict market highs or lows. You just stay consistent. That's dollar cost averaging in action. It removes emotion. It keeps your money flowing into assets. It builds momentum. Think of DCA as your discipline engine. Compounding starts multiplying the results. As your regular investments grow, they start producing profits, and those profits get reinvested to make more profits. That's compound interest, the accelerator of your system. Every time your dividends or returns are reinvested, your capital base grows. Each new return is bigger than the last one. Time becomes your ally. You don't need higher returns, just more time in the market. The rule of 72 tells you when your patience will pay off. The rule of 72 acts like your dashboard gauge. It tells you approximately how long it'll take to double your money based on your average return rate. For example, if your average return is 12%, then 72 over 12 equals 6 years to double. If you invest for 24 years, your wealth doubles 4 times. Your consistent DCA deposits plus compounding returns equals exponential growth. Together, they form the wealth flywheel. Here's how the full loop works. You can see the code in our conversation history. Each loop is faster and bigger than the last, just like Buffett's compounding machine at Berkshire Hathaway. Example, how they team up in real life. Let's say you invest 1,000 EG per month, average annual return equals 10%. You keep investing for 20 years. Year 1 of 5, DCA keeps you investing through market ups and downs. Compound interest starts to build slowly. Year 6 through 12, rule of 72 says you've doubled your first lump. Compounding now accelerates. Year 13 to 20, your previous doubles are now compounding on top of themselves. The chart curves upward like a rocket. You've built wealth without trading, gambling, or guessing. Why they work best together. Concept, alone, together. Compound interest grows your wealth, but only if you stay invested. DCA ensures you keep feeding it every month. Rule of 72 tells you how long to double, but only if you're patient. DCA plus compounding make that patience profitable. DCA keeps you safe in volatile markets, but slow without compounding. Compounding turns slow progress into exponential growth. Together, they make you wealthy by habit, not by luck. The wealth formula, open quote, consistent DCA plus time plus compounding equals predictable doubling. Rule of 72, wealth, close quote. Or as Buffett would say, open quote, do not underestimate the power of slow, steady compounding. It looks boring until it looks impossible, close quote. Would you like me to turn this combo into a wealth flywheel diagram? A visual that shows how DCA, compounding, and rule of 72 feed each other in a circular motion?